Welcome to Griffonomics.
Glad to be diving into this one today.
Yeah, so today, for you listening, we are going to be doing a really granular deep dive into something you probably don't even realize is basically running the physical world around you.
Right. It's totally invisible to most people.
Exactly. I mean, we're talking about trillions of dollars in global construction spend, billions of dollars in freight logistics, and just millions of heavy machines operating in the dirt all over the world right this second.
And the company behind a massive chunk of that is Trimble Inc.
Right, Trimble. And the mission for this deep dive is to unpack this huge physical digital inflection point they're going through.
Yeah, it's a fundamental transformation. They're aggressively moving from being this legacy hardware manufacturer into a really high-margin integrated industry cloud platform.
Which is wild. And just so you know, we're getting all this. We're pulling from a massive stack of sources today.
We've got their full FY 2025 financial reports, the Q4 earnings transcripts, strategic market analyses, and those really detailed investor presentations from the Raymond James and Piper Sandler conferences.
Yeah, so we're going to unpack their capital allocation, this really aggressive divestiture strategy they have, how they're monetizing AI, and this crazy $1.4 billion internal cross-sell engine.
It's a lot to cover.
Yeah.
But to really grasp the scale of this, you first have to understand just how historically fragmented these industries are.
Oh, yeah. Like construction and freight have always operated in these massive data silos, right?
Exactly. I mean, historically, the architect's design didn't natively talk to the structural engineer's model.
Right.
And that definitely didn't talk to the contractor's ERP system.
Which had absolutely zero connection to the guy driving the bulldozer on the actual job site.
Right. And Trimble's whole core thesis right now is erasing those boundaries.
So let's look at how they're actually doing that, because their technology stack is, it's pretty complex.
It is. They basically operate in three primary pillars.
Right. So we have AECO, field systems, and transportation and logistics.
Yeah, let's start with AECO, which is architecture, engineering, construction, and owners.
Right, and that owners part is super important, isn't it?
It's the critical shift. Because historically, a contractor finishes a building and just hands over a bunch of fragmented, outdated PDF manuals to the facility owner.
Oh, I've seen those. Just massive binders of paper.
Exactly. But now, the goal is handing over a perfect digital twin of the building.
Wow. Okay, so in the AECO segment, Trimble basically owns the data flow from the very first sketch, right?
Yeah, you have architects using their software like SketchUp for this rapid 3D modeling.
Which is super popular.
Right, but then that conceptual model has to become structurally viable. It has to actually stand up.
So they use something else for that.
Yeah, that's where Trimble's Tekla software comes in. It's basically the industry standard for highly detailed building information modeling.
Gotcha.
Specifically for, like, structural steel and concrete.
Okay, so the engineers use Tekla to make sure the building won't collapse. But then that data still has to flow to the general contractor, right? Because they have to build it on budget.
Exactly. And that involves a completely different set of tools within that AECO pillar. Trimble integrates these project management and ERP solutions like Viewpoint and eBuilder.
Oh, right. So that handles the gritty stuff.
Yeah, payroll, subcontracts, RFIs, change orders.
And then when the ribbon is cut, they have the asset management tools to help the owner actually run the place for the next 50 years.
Exactly. The data continuity is the actual product.
That's wild, but that's just the software side, right? Like in the office.
Right. The second pillar is field systems. This is where the data actually hits the dirt.
Yeah, so this includes their geospatial tech and civil construction hardware, which is basically the legacy core of Trimble, right?
Yeah. I mean, for decades, if you drove past a highway project and saw a surveyor holding a yellow pole with a white disc on top.
Yeah, I've seen those everywhere.
Right, that was Trimble GNSS's hardware.
Yeah.
But the evolution of those field systems is really the mechanical link between the digital model and the physical world.
So like machine control, let's unpack that. Because historically, grading a site meant, driving wooden stakes into the ground, right?
Yeah, using a laser level, and you'd have a highly skilled bulldozer operator constantly manually adjusting the blade just based on visual cues.
Which sounds so slow.
It was slow, super prone to human error, and it required constant rework.
And rework in heavy civil construction just absolutely destroys margins. Like if you over-excavate a trench by, say, 6 inches, you have to pay for the diesel to haul that extra dirt away.
Yep.
And then you have to pay for the engineered fill and the concrete to fill it back up. It's a nightmare.
Exactly. But Trimble's machine control systems eliminate that entirely.
How does it actually work in the cab?
Well, they take that highly accurate 3D model from the AECO software, and they upload it directly via the cloud to a computer inside the cab of a massive Caterpillar or Komatsu earth mover.
Wow, so the machine just knows.
Yeah. The machine is equipped with dual GNSS receivers and inertial measurement units.
Okay.
The onboard computer knows exactly where the blade is in 3D space, literally down to the millimeter.
Down to the millimeter on a massive bulldozer.
Yes. And the system actually takes over the hydraulics of the bulldozer. It automatically raises and lowers the blade to match the digital design while the operator just drives forward.
That is insane. It's basically like turning a massive piece of heavy machinery into a precision 3D printer for dirt.
That's a great way to put it.
Okay, so that's two pillars. What about third? Transportation and logistics.
Right, so T&L manages the physical movement of the materials you need to build all this stuff. It's the supply chain nervous system.
So this is like telematics for routing and fuel optimization.
Yeah, but the real crown jewel here is Transporion.
Transporion. Okay, I saw that in the sources. What is that exactly?
It's this massive, multi-sided freight marketplace based in Europe. It connects shippers, forwarders, and carriers, digitizing the whole end-to-end transportation process.
So it's not just like tracking a truck on a map.
No, not at all. It's algorithmic freight matching, dynamic dock scheduling, and even carbon emission tracking across the whole supply chain.
Okay, so we've got the software to design the asset, the hardware and software to physically build it, and the logistics network to supply it.
Right.
But the real story in our sources, and honestly the reason analysts are upgrading the stock right now, is what they call this revenue infrastructure shift across all three of these pillars.
Oh, yeah. The fundamental DNA of Trimble's revenue has been totally re-engineered. The shift is staggering when you look at the timeline.
Lay it out for us. What are the numbers?
So back in 2020, recurring revenue made up roughly 40% of Trimble's total revenue.
Okay, 40%.
Yeah, and the rest was cyclical, perpetual software licenses and one-off hardware sales. But by the end of 2025, recurring revenue hit 65%.
Wow, from 40 to 65.
And if you combine software services and recurring revenue overall, it now makes up 79% of their total business.
That's crazy. They took a business that was historically anchored in selling physical GPS receivers and turned it into an 80% software and services company.
Exactly. And that transition has a massive impact on their valuation multiples and their capital efficiency. It fundamentally changes how the market values every single dollar of revenue.
Right, because a hardware dollar is cyclical, right? It depends on like CapEx cycles in construction and agriculture.
Exactly. But a SaaS dollar is predictable. It's ratable, and it compounds.
Okay, let's unpack this for a second. It's kind of like a company transitioning from selling you a single hammer to selling you the central nervous system that automatically guides every tool on the entire construction site.
That's the perfect analogy. And the mechanical shift in how they sell their products is fascinating. Take that machine control we were just talking about.
The 3D printer for dirt.
Right. Instead of selling a contractor a $100,000 piece of hardware up front, they've shifted toward machine control as a service.
Oh, interesting. So it's a subscription.
Yeah, it's called Trimble Works Plus.
Okay, let's break down the mechanics of why that works so well for the contractor. Because construction is an incredibly cyclical, cash-constrained business.
Oh, absolutely.
Like if I'm a mid-size earthworks contractor, dropping $1 million in CapEx to outfit 10 bulldozers destroys my balance sheet.
Right. You'd have to finance it, take on debt, and just pray the market doesn't turn before the equipment actually pays for itself.
Right. But under this Works Plus model, I'm assuming you aren't actually buying the hardware.
Exactly. You are subscribing to the outcome. Trimble provides the hardware, the software upgrades, the data connectivity, and even accidental damage protection for just a predictable monthly fee.
So the contractor moves that cost from a massive upfront CapEx to an operational expense, OpEx.
Yep. It perfectly matches their software costs directly with their project revenue.
And for Trimble, it creates immense revenue visibility. Plus, it leads to this dynamic that trips up a lot of people analyzing SaaS companies for the first time, which is negative net working capital.
Yes. The sources really highlight that Trimble operates with negative NWC.
Can you explain that? Because in traditional manufacturing, positive working capital is normally a good thing, or at least a requirement.
Right, but it's actually a drag. In traditional hardware, your cash is trapped. It's sitting in raw materials, work in progress, and finished goods just gathering dust in a warehouse.
Right.
But Negative networking capital in a SaaS model means the customers are essentially funding the company's daily operations.
How so?
Customers pay upfront for their annual software subscriptions, right? So Trimble gets the cash on day one, but they recognize that revenue ratably over the next 12 months.
Oh, wow. The cash flow dynamics of that are incredible. You collect the cash immediately, you can invest it or return it to shareholders, and you deliver the service at a near zero marginal cost over the course of the year.
Exactly. It is the ultimate hallmark of a highly efficient, asset-light compounding machine.
Okay, but arriving at this asset-light model required some really ruthless corporate pruning. I mean, you don't just get to 80% software revenue by accident when you have a 40-year history of building physical stuff.
Yeah, you really don't. And this brings us to the strategic inflection point that management calls connect and scale.
And this came with a massive phase of radical business simplification, right?
Mm.
Because our sources show that since 2020, Trimble has aggressively divested 23 non-core or hardware-heavy businesses.
Yeah, 23.
23. Let's apply some scrutiny here, because divesting 23 businesses in 4 years isn't just pruning.
No, it's a structural overhaul.
Right. So I have to ask, doesn't this massive garage sale essentially admit that their M&A strategy for the previous decade was a total failure?
That's a fair question.
Like, they bought all these disparate, hardware-heavy point solutions, realized they couldn't integrate them or operate them efficiently, and just dumped them. Why should the market view this as a strategic masterstroke rather than just a massive forced cleanup of bloated write-offs?
Well, that is the exact cynical and honestly necessary question that analysts were asking 2 years ago.
Yeah, it seems obvious.
But if you look at the historical context, in the 2010s, Trimble's strategy was to acquire absolute market share in every conceivable niche of physical measurement.
Okay, so just buy everything.
Yeah, if a company made a specialized laser for aligning timber, Trimble bought them. The strategy was land grab, it wasn't integration.
Right. They were assembling a massive catalog of isolated tools, not building an ecosystem.
Precisely. And the connect and scale strategy was management's admission that the world had changed. Customers no longer wanted 50 different vendor logins. They wanted integrated data flows.
So all those hardware divisions were just holding them back.
Yeah, maintaining the R&D, the supply chains, the manufacturing facilities for 23 niche hardware divisions was literally starving their core software platforms of capital.
Oh, I see.
They weren't necessarily bad businesses. They just didn't fit the new margin profile or the industry cloud vision.
Okay, so let's examine the mechanics of how they actually shed the largest of these assets. Because they didn't just liquidate them, did they?
No, and that's the brilliant part. The divestiture of their agriculture segment in 2024 is the prime example.
Right. This was a legacy business providing precision agriculture displays and steering systems for tractors. So how do you exit a business that is deeply embedded in the ag supply chain without just destroying all the value you built?
You transition from an owner-operator to a strategic shareholder.
Okay.
So Trimble formed a joint venture with AGCO, which is a massive global manufacturer of agricultural machinery. AGCO bought an 85% stake in Trimble's ag assets, creating a new entity called PTx Trimble.
And the financial engineering on that deal is fascinating. The sources say Trimble received $1.9 billion in upfront cash proceeds.
Exactly. That is a massive infusion of non-dilutive capital. But the real brilliance is in the 15% equity stake they retained.
Right, they kept 15%. Why?
By partnering with an OEM like AGCO, Trimble's precision tech gets factory fitted directly onto the tractors as they literally roll off the assembly line.
Oh, instead of relying strictly on aftermarket sales.
Yes. Trimble shed the operational drag, the inventory risk, and the supply chain headaches of actually manufacturing the hardware.
But they still capture 15% of the upside.
Exactly, in a market where they have a massive competitive advantage.
That's incredibly smart. And they ran the exact same playbook in early 2025 with their transportation and logistics segment, didn't they?
They did. They took their global transportation telematics business, the mobility division, which historically required installing physical hardware boxes inside the cabs of commercial trucks, and they sold it to a company called Platform Science.
So again, shedding the hardware, but keeping the connectivity. Because they took a 32.5% equity stake in the newly expanded Platform Science entity.
Right. It's the definition of capital allocation discipline.
Yeah.
They are systematically removing low-margin, capital-intensive hardware operations from their balance sheet and rotating that trapped capital into high-margin software R&D.
While retaining minority stakes to ensure their software ecosystem still has a pipeline to the physical machines. It's really elegant.
And by shedding those 23 businesses, they narrowed their focus entirely on what management calls software compounding.
Because the R&D dollars are no longer split across dozens of dying hardware product lines.
Exactly. They are concentrating over $600 million a year purely into integrating their core platforms.
Wow, over 600 million. And that concentration of R&D capital is what allowed them to build a highly defensible moat around their most critical future growth driver, which we have to talk about, artificial intelligence.
Oh, definitely. Every industrial software company is pitching an AI story right now.
Right. It's the buzzword of the decade.
But Trimble's approach to what they call agentic AI is fundamentally different from the generic conversational models that the broader market is obsessed with.
Yeah, we really need to unpack the technical mechanisms here for you listening. Because generic large language models, the foundational models driving the consumer AI boom, they are probabilistic.
Right.
They are trained on the massive, messy corpus of the public internet to basically predict the next most likely token in a sequence.
Which is fine for a lot of things.
Yeah, if you ask a generic LLM to write a marketing email, probabilistic guessing works great. But if you ask it to calculate the sheer strength of a structural steel I-beam in a seismic zone.
Probabilistic guessing is how buildings collapse.
Exactly. There is zero room for error.
And that's exactly why Trimble operates in what are called systems of record. In heavy civil engineering, there is zero tolerance for AI hallucination.
So how are they avoiding that?
This is where Trimble's proprietary data moat becomes an insurmountable advantage against generic tech disruptors.
Okay, lay it out for us.
Trimble doesn't train its specialized AI on Wikipedia. It trains it on tens of terabytes of proprietary reality capture data.
What does that actually look like?
We are talking about highly structured 3D point clouds from laser scanners, precise geospatial coordinates from their GNSS networks, and 45 years of historical structural engineering calculations straight from Tekla.
And they also have the financial data, right? Like billions of dollars in freight transactions and construction cost data flowing through their ERPs.
Exactly. It is an incredibly dense, multimodal, proprietary data set.
So how are they deploying this data to build actual monetizable products? Because data is just data until you use it.
Right. They are rolling out highly specialized agentic AI.
Agentic AI.
Yeah, and agentic AI doesn't just answer questions. It autonomously executes multi-step workflows within a specific software environment.
So it actually does the work.
Yes. Let's look at the submittals AI agent, which the sources highlight as a massive success.
Oh, the submittal process. That is the absolute bane of every project manager's existence in commercial construction.
He really is.
For context, for those who don't know, a submittal is the formal process where a subcontractor basically proves to the architect that the materials they intend to use exactly match the design specifications.
And on a billion-dollar data center project, there are tens of thousands of submittals.
Yeah, it is an agonizingly manual process. You're emailing massive multi-page PDFs of product data sheets, cross-referencing them against the spec book.
Getting a structural engineer to manually stamp them.
Yes, and tracking all those approvals in a massive spreadsheet. It's a huge bottleneck that delays schedules and just burns millions of dollars in administrative overhead.
Well, the submittals AI agent fundamentally changes this workflow.
How does it do it?
It utilizes advanced optical character recognition and specialized natural language processing that is trained specifically on architectural and engineering jargon.
Okay, so it understands the language of the industry.
Right. It doesn't just read the PDF, it understands the context. It can extract the exact material specifications, automatically cross-reference them against the 3D model requirements, route the submittal to the correct engineer for review, and flag any discrepancies instantly.
That's incredible. And the sources note that one of their major enterprise clients, the general contractor Hensel Phelps, estimates this specific AI agent is saving them millions of dollars in labor hours alone.
Millions. That is hard ROI.
Yeah, that's real money. And we see the same hard ROI in another tool, the MEP estimating AI, right?
Oh, definitely. MEP, mechanical, electrical, and plumbing, is incredibly complex to estimate.
Right, because traditionally, a highly paid estimator sits in front of complex 2D or 3D drawings and manually counts every single linear foot of pipe.
Every junction box, every air handler, just to build a cost bid.
It's so tedious. And it's error-prone. If the estimator misses a major conduit run, the contractor eats that cost and destroys their margin on the job.
Exactly. But the MEP, estimating AI, utilizes advanced computer vision algorithms trained specifically on engineering symbology.
So it can look at a blueprint and just know what it's seeing.
Yeah, it can analyze a complex drawing and automatically recognize the difference between a 3-inch PVC pipe and a 4-inch cast iron pipe.
That's wild.
It extracts all those components instantly, generating an automated takeoff for the estimator to simply review and verify.
So the human is just checking the work instead of doing the counting?
Right. The source report this is delivering over a 50% productivity gain for estimators.
50%. But, the real brilliance of Trimble's strategy here isn't just the technology itself, it's the monetization mechanism.
Right, how they actually make money off of it.
Yeah, exactly. They aren't just bundling these AI features into a free software update to justify an annual price hike. They are monetizing agentic AI via consumption credits.
It's a highly scalable, usage-based revenue model.
So how does that work in practice?
Well, when an enterprise customer licenses a core platform like Tekla or Viewpoint, that base license includes a certain allotment of AI compute credits.
Okay. Here's where it gets really interesting, actually. It's essentially a digital arcade, right? You buy a bundle of tokens.
That's a great way to think of it.
And every time you ask the MEP AI to process a massive set of drawings, it costs a certain number of tokens based on the compute power required.
Right. And because the AI is delivering such massive, verifiable productivity gains, saving estimators 50% of their time, customers rapidly burn through their base allotment of credits.
Oh, I'm sure.
And when they see the ROI, purchasing additional bundles of consumption credits becomes a completely frictionless decision.
Yeah, it's a no-brainer. It creates a brand new, highly profitable, recurring revenue stream that scales linearly with customer usage. It's totally decoupled from standard seat-based licensing.
Exactly. And it creates incredible software stickiness.
Stickiness.
Yeah, think about it. Once a contractor integrates an agentic AI that automates their submittals and halves their estimating time, the switching costs to move to a competitor become astronomical.
Right, because you aren't just changing software, you are firing your most efficient digital employee.
Exactly. You'd lose all that baked-in efficiency. And this stickiness is the foundational prerequisite for the next major phase of their strategy, the land and expand sales motion.
Oh, yes. This brings us to the $1.4 billion cross-sell engine that management identified in the investor presentations.
This is a huge number.
$1.4 billion in cross-sell and upsell opportunity entirely within their existing customer base. That means zero customer acquisition costs.
Zero.
They don't need to steal a single customer from Procore or Bentley. They just need to sell more modules to the contractors who already use their ERPs.
Right, and breaking that down, the sources show it's a $1 billion total addressable market TAM just within the AHECO segment.
And another $400 million opportunity in the transportation and logistics segment.
But look, identifying the TAM is the easy part.
True.
The friction of enterprise software procurement is what usually kills cross-selling in its tracks.
What do you mean by that?
Well, historically, if a massive civil contractor was using Trimble's heavy civil ERP and wanted to add their advanced project management suite, it wasn't just a simple upgrade button.
Right.
It required negotiating an entirely new master services agreement.
Ugh. That means sending a new contract through the client's legal department for indemnification review, fighting with procurement over data privacy terms, and basically waiting 6 months for the IT steering committee to approve it. It's a nightmare.
And that administrative friction artificially capped Trimble's growth.
So how are they fixing it?
To unlock that $1.4 billion opportunity, Trimble engineered a completely new contracting framework known as TC1, or Trimble Construction One.
TC1. Okay, how does that bypass the friction?
TC1 acts as a single master commercial framework. When a customer signs on to TC1, they undergo that painful legal and procurement negotiation exactly once.
Just once.
Right. They agree to the overarching terms, conditions, and data security protocols for the entire Trimble ecosystem right up front.
Oh, wow. So after that initial MSA is signed, adding a new software module, whether it's the MEP estimating AI, an equipment tracking tool, a carbon emissions calculator, is structurally frictionless.
Completely frictionless. It shifts the sales motion from complex enterprise software sales to simple account-based expansion.
The sales rep can just offer additional modules as simple addendums to the existing TC1 contract.
Exactly.
Okay, but let's subject this to some rigorous debate for a second. Is the enterprise software market actually moving toward monoliths?
What do you mean?
Well, for the last decade, the mantra in IT has been best of breed, right? If I'm a CIO at a major construction firm, I want the absolute best estimating tool from vendor A, the best project management tool from vendor B, and the best machine control from vendor C.
Right.
I don't want to be locked into Trimble's ecosystem just because the contract is easier to sign. Doesn't the open API economy make a monolith like TC1 sort of irrelevant?
That's a great point.
Yeah.
But the best of breed argument makes sense in a purely digital environment, like marketing tech, where moving data between SaaS apps via APIs is relatively simple.
Okay.
But in the physical digital world of heavy construction, the API tax is crippling.
The API tax. Explain how that manifests on an actual job site.
Well, when you string together best-of-breed tools from 3 different vendors, you bear the burden of integration.
Right, someone has to make them talk.
Exactly. You have to hire software engineers to build custom APIs to ensure the 3D model from vendor A translates perfectly into the machine control format for vendor C.
Which sounds expensive.
It is. And if vendor A updates their software and breaks the API, yeah, your bulldozer on a remote highway project in the middle of nowhere literally stops working because it can't read the grade data.
And when a machine stops, you are burning thousands of dollars an hour in labor and equipment costs, while some software engineer tries to debug an API integration.
Exactly. In construction, data latency and integration failures have massive physical and financial consequences.
Okay, that makes total sense. So the value proposition of TC1 isn't just a simpler contract, it's guaranteed native data continuity.
Right. The 3D model flows natively to the ERP for costing, natively to the AI for estimating, and natively to the bulldozer for grading, all within a unified data environment.
And the ROI of that frictionless workflow exponentially outweighs the marginal feature benefits of a standalone best-of-breed app.
Precisely. And TC1 perfectly enables their current M&A strategy, too.
Oh, right, because their M&A strategy has shifted dramatically from those massive, bloated hardware acquisitions of the past.
Yeah, now they focus on what they call tuck-in acquisitions.
The sources highlight several of these tuck-ins, right? Like Traxpera and Trimble materials.
Yeah, these are highly focused, niche software companies. Traxpera, for example, solves a very specific problem: mobile time cards and field data collection for remote laborers.
So by themselves, Traxpera is just a tiny point solution.
Right. But when Trimble acquires them, they natively integrate that time card functionality directly into their massive Viewpoint ERP system.
Ah. And because of the TC1 framework, Trimble can instantly push that new time card module out to thousands of existing enterprise customers with zero procurement friction.
Exactly. They acquire the specific capability, plug it into the unified ecosystem, and immediately monetize it across their massive installed base.
The time to ROI on these software tuck-ins must be remarkably fast compared to their historical hardware acquisitions.
It's night and day.
Okay, so this unified software strategy powered by AI and frictionless cross-selling, it sounds invincible on paper.
It does.
But as rigorous analysts, we have to look at the actual tape. Does the financial reality of FY 2025 actually justify this strategic narrative? Let's dive into the full year review.
Sure. So the top-line numbers demonstrate significant momentum. For the full year 2025, Trimble reported total revenue of $3.587 billion.
Okay, almost $3.6 billion.
But the critical metric inside that number is the 10% organic growth rate.
Right, organic growth. Let's clarify why that matters so much here. Because when a company is doing massive joint ventures, divesting 23 businesses, doing tuck-in M&A...
the top-line revenue number is inherently noisy.
Exactly. Organic growth is the only metric that matters because it strips out the inorganic revenue bought through acquisitions and it strips out the negative impacts of divestitures.
Right. A 10% organic growth rate proves that their core retained software platforms are actually capturing market share on their own merits.
And the quality of that revenue is improving rapidly, too. Their annualized recurring revenue, or ARR, reached $2.39 billion.
Which represents an organic ARR growth of 14% year over year.
Wow, 14%.
Yeah. And that 400 basis point spread between total organic growth at 10% and organic ARR growth at 14%.
Right.
It proves that the recurring revenue engine driven by TC1 cross-selling and those AI consumption credits is pulling the entire company forward.
And it's incredibly profitable growth, too. The non-GAAP EPS for 2025 was $3.13, which actually beat the high end of management's own guidance.
It did.
So let's talk about capital allocation, because an asset-light software business with negative net working capital throws off a mountain of free cash flow. What are they doing with all that cash?
Well, their balance sheet is pristine right now.
Yeah.
They are currently operating with a net leverage ratio of 1.1x.
1.1x. And their internal threshold to maintain a comfortable investment grade rating is 2.5x.
Exactly. This means they have massive debt capacity that they simply don't need to tap.
So they aren't hoarding the cash, and they
Yeah.
clearly aren't blowing it on massive dilutive acquisitions anymore.
No, they are aggressively returning it. In 2025 alone, they executed $863.4 million in share buybacks.
Nearly $1 billion in buybacks. Deploying that much capital when your leverage is that low is a massive signal of confidence from the management team.
It absolutely is. They clearly believe the market is still undervaluing the long-term cash generation potential of their software transition.
And they are accelerating the strategy, right? Because the board just authorized a new $1.0 billion stock repurchase program heading into 2026.
Yep. And looking ahead to that 2026 guidance, they projected a midpoint revenue of $3.86 billion, which is roughly 7.5% growth.
Okay.
They expect ARR growth to remain robust at 13% and EPS to hit $3.52.
But the number that really jumps off the page for me is the margin expectation. They expect EBITDA margins to expand to 29.8%.
Yeah, nearly 30% EBITDA margins on almost $4 billion in revenue is elite tier for industrial software.
It really proves the operating leverage of the TC1 model. I mean,
Yeah.
once the core software architecture is built, every additional cross-sell module just drops straight to the bottom line. The numbers are undeniably strong. But we have to stress test this thesis. We have to look for the structural vulnerabilities.
Always.
And there's a glaring issue buried in the financial disclosures that demands serious scrutiny here. Trimble disclosed material weaknesses in internal control over financial reporting related to business combination accounting.
Yeah, this is where we need to have a serious debate about execution risk.
Because a material weakness in internal controls is a massive red flag for institutional investors.
It is. It means the external auditors, likely a Big Four firm, found severe deficiencies in how the company accounts for its financial transactions.
Let's be clear about what this usually implies for the listener, though. It rarely means cash is actually missing.
Right.
But business combination accounting specifically relates to how they value the assets and liabilities during M&A and divestitures, right?
Yeah, it's how they calculate goodwill, intangible assets, and ongoing tax liability.
And when you execute 13 acquisitions and 23 divestitures in a condensed time frame,
including massive complex structures like spinning off a $1.9 billion ag business into a joint venture.
right, the accounting complexity there must be staggering.
It is. The material weakness basically indicates that their internal accounting department simply couldn't scale to match the sheer velocity of their corporate development team.
Which is concerning. Because the risk here isn't just a restatement of past earnings. I'll play devil's advocate. The risk is integration rot.
What do you mean by integration rot?
Well, if their accounting systems are overwhelmed by the complexity of the portfolio, what does that say about the actual technical integration of the software platforms?
Oh, I see.
Like, if they can't accurately value the goodwill of a tuck-in acquisition, can we really trust that they are flawlessly integrating its code base into the Viewpoint ERP?
That is the exact bear case.
Yeah.
And it's a strong one. Management has publicly acknowledged the weakness, and they are undergoing aggressive internal remediations to rebuild those controls.
Right. But until the auditors sign off on a clean bill of health, it acts as a permanent overhang on their valuation multiple. Institutional capital just hates accounting uncertainty.
They do.
So let's shift from internal execution risk to external macro exposure, because the sources are very explicit about the headwinds in their transportation and logistics segment.
Yes, the T&L segment. They are currently navigating a highly constrained recessionary global freight market.
And the T&L segment is deeply tethered to the physical economy.
Exactly. When industrial production slows and consumer demand dips, less freight moves. Plain and simple.
But to understand the true impact on Trimble, we have to look at the mechanics of Transporion, their European freight marketplace. Because Transporion monetizes heavily on transaction volume, particularly in the spot market.
Right, let's differentiate between contract freight and spot freight for a second.
Yeah, explain that dynamic.
So large shippers prefer contract freight. They like locking in a stable rate with a carrier for a year to move a predictable amount of goods.
Makes sense.
But supply chains are chaotic. When a shipper has an unexpected surge in volume, or a contracted carrier fails to show up, that freight falls into the spot market.
Where rates are dynamic and highly volatile.
Exactly. Right now, during a freight recession, capacity is loose, carriers are desperate for miles, So shippers have no problem securing cheap, stable contract rates.
So they don't need the spot market.
Right. Consequently, volume in the highly profitable dynamic spot market dries up, and this is severely compressing growth in the T&L segment.
Ah, okay. But the architecture of a platform like Transporeon means this headwind is actually a coiled economic spring, isn't it?
It absolutely is. Think about it.
Yeah.
The software infrastructure is fully built. The fixed costs are sunk.
Right.
So when the macroeconomic cycle inevitably turns, when industrial production ramps back up, and supply chains tighten, freight will spill over from contracts back into the spot market.
And because Transporeon takes a fee on those spot transactions, that recovered volume will just flow right through their system at nearly 100% incremental margins.
Exactly. It is a massive built-in operating leverage lever just waiting for the macro environment to improve.
Okay, another macro risk we should touch on is their legacy reliance on global supply chains for the hardware they do still manufacture, like the precision GNSS antennas.
Yeah, that's still a factor.
But more importantly, their field systems are inherently dependent on the actual satellite constellations, the global navigation satellite systems operated by various governments.
Right. If there's a major geopolitical conflict that results in the jamming, spoofing, or destruction of GPS, GLONASS, or Galileo satellite networks.
Which feels increasingly relevant these days.
Yeah, Trimble's heavy civil and geospatial operations would be severely degraded.
Yeah.
It is an existential, albeit low probability, tail risk.
But while they are exposed to global macro risks, they are actively constructing immense regulatory moats domestically.
This is a huge point.
Yeah, the sources detail their aggressive push into sovereign cloud architectures and federal security certifications. They recently achieved FedRAMP Moderate 8.0 for their eBuilder project management software and the TX-RAMP equivalent in Texas.
The strategic value of these certifications cannot be overstated.
Really? Why is that?
Because FedRAMP, the Federal Risk and Authorization Management Program, is a grueling, highly expensive cybersecurity audit process. It can take years and millions of dollars to achieve an authority to operate, or ATO.
So why burn the capital to achieve it?
Because of the massive influx of federal infrastructure spending. We are talking about billions of dollars allocated for rebuilding highways, upgrading the power grid, modernizing military installations.
Right.
And the federal government mandates that any cloud software used to manage these critical infrastructure projects must be FedRAMP certified.
Oh, it's the ultimate barrier to entry.
Exactly. A nimble, venture-backed construction tech startup simply doesn't have the capital, the compliance infrastructure, or the years of runway required to pass a FedRAMP audit.
They're locked out.
Precisely. By achieving FedRAMP Moderate, Trimble isn't just securing their own data. They are legally locking their smaller competitors out of the most lucrative public sector projects in the country.
It transforms regulatory compliance from an operational cost center into a massive, offensive, strategic moat. That is brilliant.
It really is.
Okay, so this brings us to the synthesis of everything we've analyzed today for you listening. The divestitures, the AI integration, the TC1 cross-selling engine, and the regulatory moats. They all point toward a very specific destination.
Yeah, and management has formalized this as their 2027 goal. They call it the 3-4-30 target.
The 3-4-30 target. Let's break that down.
It's a highly transparent scorecard for investors to measure their execution. By 2027, Trimble aims to reach $3 billion in annualized recurring revenue.
That's the 3.
$4 billion in total revenue.
The 4.
And achieve 30% EBITDA margins.
The 30. Okay, the 3-4-30 framework simplifies a vastly complex industrial transformation into 3 clean metrics.
And Wall Street is actively buying into this trajectory.
Yeah, the analyst notes from KeyBank Capital Markets upgraded the stock to an overweight rating and established a $99 price target. But the rationale is the key here. They designated Trimble as a re-rating play.
A re-rating play is the holy grail for a transitioning company.
Explain why.
For a decade, institutional algorithms and portfolio managers categorized Trimble as an industrial hardware manufacturer.
Right.
They looked at the cyclicality of GPS receiver sales and assigned the stock a suppressed hardware-level valuation multiple, maybe 15 or 18 times forward earnings.
But the connect and scale strategy mathematically broke that thesis. I mean, you cannot value a company generating 80% of its revenue from predictable, high-margin software subscriptions at a hardware multiple.
Exactly. The analyst upgrade signifies that the broader market is finally capitulating. Wall Street is recognizing that Trimble has successfully crossed the chasm.
So the market is re-rating the stock.
Yes. Assigning it the premium valuation multiples, perhaps 25 to 30 times forward earnings, that are usually reserved for elite, compounding SaaS platforms.
So, synthesizing this entire deep dive, what does this actually mean for you navigating the future of technology investments? Because we constantly obsess over hyper-visible, consumer-facing tech.
Right, everyone's looking for the next viral app or the newest smartphone iteration.
But the fundamental transformations, the shifts that restructure the global economy and generate immense compounding wealth, they're happening in the dirt.
They are happening inside the fragmented, highly complex foundational industries that literally build the physical world around us.
Trimble engineered a masterclass in corporate evolution here.
Yeah.
They possess the discipline to aggressively amputate 23 legacy businesses to starve their distractions and feed their core.
Yeah.
They transitioned from selling isolated tools to selling a unified, AI-powered nervous system for physical reality. They solved the procurement friction that plagues enterprise software with the TC1 framework, unlocking a $1.4 billion internal growth engine.
And they protected it all with an insurmountable proprietary data moat of reality capture that generic AI models can never replicate.
Which leaves us with a final, massive strategic implication to consider. Look past the 2027 financial targets for a second. If Trimble continues to successfully integrate the architectural design, the structural engineering, the heavy civil machine control, and the global freight logistics into a single, seamless industry cloud.
They aren't just optimizing workflows for contractors.
No. They are systematically constructing the definitive, interconnected digital twin of the global economy.
A reality where every blueprint, every cubic yard of excavated earth, and every ton of structural steel is tracked, modeled, and optimized right within their ecosystem.
If one single company successfully owns the software bridge between digital design and physical execution, they become the undislodgeable operating system of physical reality itself.
The economic value of owning that bridge is almost impossible to quantify, but it will undoubtedly define the next decade of industrial evolution.
Risk defined, portfolio protected.